Yes, let us start with our next segment of strategies. This segment it is known as spread strategies. Now, what we do in spread strategies is we will be simultaneously buying and selling the same type of option. See, what we were doing in combination strategies is we were making a combination of two different options. So if I'm buying one call, then I will also buy one put, or maybe two calls and one put, or maybe two puts and one call. But we were dealing with two different options. In spread strategies, we will be buying one option, simultaneously we will be selling an option, but it will be the same option. That means either we are buying a call option and simultaneously selling a call, or we are buying a put and simultaneously we are selling a put. Now, why are we calling this as spread strategies? See, by spread we mean difference. Over here, when we are using this word spread, by spread we mean difference. You may wonder, difference of what? In a spread strategy, the spread is referring to the difference in the premium. See, you will buy a call option, so you will have to pay premium. You will sell a call option, so you will receive premium. So premium paid minus premium received, that is the spread that we are referring over here. Now, there are three extremely popular spread strategies. One after the other, let us discuss each of the spread strategies at a greater length. Okay, the first one that I want to discuss here is a bull spread. You can even say bull spread strategy. I want to discuss with you a bull spread over here. As it is becoming very clear in the title of the strategy itself, this is a strategy that we will be preferring when you have a higher chance of the stock markets rising or a higher chance of the share prices rising. In short, you are bullish with respect to the markets. If you are bullish, then we are going to enter into a bull spread strategy. Now, when we are bullish, ask yourself, when you are bullish, which is the option that you prefer? When you are expecting that the share prices will rise, when you're expecting that the markets will be rising, which option do we prefer? We prefer a call option. So let us go for a bull spread, which is involving a call option. Now, what I do is, as we have always been doing, we'll take certain figures and then try to understand that how this entire strategy works. Okay, now let us say there is some company XYZ Limited. Okay, its current market price per share, its current MPS, let's say is rupees 320. Okay, now call option are available. One call option is available at a strike price of rupees 300. Another call option, let's say, is available at a strike price of rupees 350. So there is some share with respect to which we are bullish. I'm very bullish with respect to this share. I'm of the view that its share price will considerably rise in the foreseeable future. And that is the reason I am interested in a call option. But as I said, we are designing a spread strategy. So in a spread strategy, I will buy one call and simultaneously I will sell one call. Okay, let us be clear now with the options premium over here. Okay, so I want to be clear about what the options premium will be. Now we know the options premium, it is the sum total of intrinsic value and the time value. Okay, and what I do here is I introduce the strike price. So one is a strike price of 300, another is a strike price of 350. Very logically, let's try to understand what shall be the premium. Now, as you can observe, the current market price right now is 320. So if you consider the strike price to be 300, you have a right to buy at 300 and then sell at 320. You will buy at 300, sell at 320. That means the money immediately that can be made is 20. Let us assume that the time value is 10. So this premium is turning out to be 30. Another call option is available at a strike price of 350. You have a right to buy at 350. Buy at 350, sell at 320. You will incur a loss. So intrinsic value is 0. For simplicity, let's assume here also the time value is 10. So these are the details that we have. So think in this way. You call up your broker, you tell the broker that, see, I'm interested in a call option. Can you give me information about the call option on the stock of XYZ? Your broker is suggesting that, yes, these are the strike prices and these are the option premium. Now we are interested in a spread strategy. So in a spread strategy, what I will do is, I will buy one call and simultaneously I will sell one call. This is what my plan is. Now, this buying and selling of the call option cannot happen at the same strike price. Buying and selling will take place at two different strike prices. See, you cannot design a spread strategy with the same strike price. A spread strategy is designed always with two different strike prices. So accordingly, we have to now take a call over here. Yeah, that's how we can say. Accordingly, we'll have to decide over here that shall we buy a call option at 300 or at 350? In other words, should I buy a call option at a higher strike price or should I buy a call option at a lower strike price? Yeah. Before that, yes, in case if you're still wondering that why I can't do at the same strike price, understand, you cannot do this at the same strike price. I'll explain that to you so that that thing doesn't come to your mind at all. Let us say, for example, we are buying and selling at the same strike price of 300. Just think for a moment. So what you do is you buy call at 300. So you will have to pay premium of 30. And then you sell call. As I said, you cannot do it at the same strike price, but I'm just illustrating before you that why you cannot do it. So you sell call at, let's say, rupees 300. That means you will receive rupees 30. So you will pay 30, you will receive 30. That means the net cost of your strategy is 0. Okay. Now just see why I'm saying you cannot do it. Okay. We take the spot price, then the strike price, right? We have one long call, we have one short call, and then we work out our gross payoff. The gross payoff will be for one long call and for one short call. And then we consider net premium paid. And finally, I'll get the net payoff. Let us say the spot price turns out to be 400 rupees. Just think for a moment. It turns out to be 400. Your call option purchased and sold is at the same strike price. Okay. Now, the call option that you have purchased is giving you a right to buy at 300. So you will buy at 300, sell at 400. You'll make a profit of 100. But you have also sold a call option. The person who has purchased the call option from you, that person will think in this way. I hope you still remember this. When we are selling options, we have only obligations. So we will not decide what shall be the decision taken. The person who has purchased the option from us, that is the person who has all the rights. That person will decide whether the option should be exercised or whether that option should be allowed to expire. I hope you are getting it. So the person who has purchased the call option from us will think in this way that I can buy at 300, sell at 400. That person will make a profit of 100. The moment that person exercises the call option, you will have to pay 100 rupees to that person. So what will happen is you will have to pay 100. So your gross payoff will become 0. The premium paid is also 0 and the net payoff is also 0. I hope you get my point. This is the reason I was suggesting to you that you cannot buy and sell option at the same strike price. Otherwise, this is what you will get. Your payoff will turn out to be zero. There's no point of doing this, isn't it? So that is the reason. We have to now decide. I'm just removing this. We will have to now decide at what strike price we should buy the call option and at what strike price we should sell the call option. The choices that we have before us is 300 strike price and 350. So the choice that is before us is, should I buy a call option at a lower strike price or should I buy a call option at a higher strike price? Tell me, what will you do? Here also again, hypothetically, you can take some figure and understand it. Okay, just think for a moment. Let's say the spot price is 400. Think in this way, spot price is 400. Then I take a strike. The choice between you is 300 and 350. Okay, 300 and 350. Now decide, where can you make more money? Where can you make more money? If the strike price is 300, you can buy at 300 and sell at 400. That means here I can make 100 rupees. And in the other situation, you will have to buy at 350 and sell at 400. So you will make 50 rupees over here. I'm ignoring the premiums over here. Premium will not be considered here, right? Premium is a sunk cost. We have to decide on the basis of the spot and the strike. You will be able to make more money in a call option if you are able to buy at a lower strike and sell at a higher spot. Lower strike. Lower is the strike price, more money you are going to make in the options trade. So I believe this settles the matter, right? I believe this settles the matter. They are saying buy one call. Okay, they are saying buy one call. So what we will do is we will buy at a strike price of 300. They are saying sell one call. We are selling at a strike price of 350. Okay, the moment you will buy this call, you will have to pay premium. The premium is 30 rupees. The moment you will sell this call, you will receive premium. The premium received is 10. So the net premium paid is turning out to be rupees 20. And we have designed a bull spread over here. Comfortable? Very quickly, I'll just walk you through what we have done till now. I'll just walk you through it very quickly. It's a spread strategy. I'm designing a bull spread. Bull spread means I'm bullish in respect of the share, and that's the reason I'm preferring a call option. Okay. I will buy a call option and simultaneously I will sell a call option. I realize that if I buy a call option at a lower strike price, then I have a possibility of buying at a lower price and selling at a higher price. Lower is the strike price of a call option, more money is to be made. So when I design a bull spread, I buy a call option at a lower strike price and simultaneously I sell a call option at a higher strike price. For the call option that I am buying, I am paying premium, and for the option that I am selling, I am receiving premium. The net premium is the reason that we are calling this as a spread strategy. So in our example, we have purchased a call at 300 and we have sold a call at 350. And the net cost of this strategy has been rupees 20, which is nothing but the net premium paid by us. Comfortable? Okay. Now what we will do is we will take certain spot prices and we will try to evaluate that how the strategy is actually operating, right? So that evaluation is done by us now. Okay, it is 300 and 350, right? That is the, what we can say, the range that we have. So first, let's take a price which is about 350, right? We have a band 300 to 350. First, let's take a price which is about 350. Okay, so why don't we start with 400 then? 400. One call option over here 300 and short call, this is turning out to be 350. Comfortable? Okay. You have a right to buy at 300. Buy at 300, sell at 400. So you can make 100 rupees over here. The person who has purchased the call option from us can buy at 350 and sell at 400. So that person can make 50 rupees. So our overall payoff is 50. We paid a premium of 20, and hence the net payoff is turning out to be rupees 30. I hope you are comfortable with it. Right. Let us take one more price which is above 350. Let's take one more price which is above that. Let us say a share price which is, let us say, 450. Let's say 450. Let's see what happens if it is 450. So you buy at 300, sell at 450. So 150 rupees is the money that we can make over here. The person who has purchased the call option from us can buy at 350 and sell at 450. So buy at 350, sell at 450. Yes, that person will make 100 rupees. Overall, it is 50. The net premium paid by us is 20, and thereby our net payoff is turning out to be rupees 30. Comfortable? Okay, we know it is 300 and 350. So let us take certain prices now which are below 300. Okay, so let us say the share price is 250. Let's check with this now, 250. So we can buy at 300 and sell at 250. Doesn't make any sense. So allowed to expire. The person who has purchased the call option from us, that person can buy at 350, sell at 250. That person will also allow the call option to expire. So it is zero. We paid a premium of 20. We have lost that premium. So the premium has been lost by us. We lost 20 rupees. One more share price which is below 300. Yes, let us say 150, 300 and 350. What do you say? Your call option is at 300. It gives you a right to buy at 300. Buy at 300, sell at 150. I have only rights. I don't have any obligation. I allow it to expire, isn't it? The person who has purchased the call option from you can also buy at 350 and then sell at 150. That person will also allow the call option to expire. Zero. You paid a premium of 20. You have lost that premium. So 20 rupees is turning out to be our loss. Now the band is 300 to 350. Now we take prices which are within this particular band. Okay, within this band. First of all, let's take a price which is closer to 350. So let's take a price 340. Let's see what will happen at 340. Okay. We have a right to buy at 300. I can buy at 300 and sell at 340. I'll make 40 rupees over here. The person who has purchased the call option from me can buy at 350 and then sell at 340. That person will allow the call option to expire. So it will be 40. I had paid 20. So my net payoff is turning out to be rupees 20 over here. Right. Now 300 and 350. So let's take a price which is within the band but near to 300. So we say 310. Okay, 310. Our call option, our long call is at 300. So I can buy at 300 and sell at 310. So 10 rupees is to be made over here. The person who has purchased the call option from us will have to buy at 350, sell at 310. That person will lose money. So allowed to expire. So 10. We paid a premium of 20. We have lost 10 rupees over here. So this is taking, certain figures and trying to understand that how the bull spread will actually work. It's very much there on your screen now, right? It's there. These are the payoffs that you will be getting. Now, what are the broad conclusions that can be drawn over here? What are the broad conclusions? The first major conclusion, your maximum loss will be the net premium paid. Just see. The net premium paid by you was 20. We have taken a series of figures. you can observe over here that the maximum loss that you are going to suffer is the net premium paid by you. You will never lose a single rupee more than that, right? So your maximum loss will be the net premium, which in our case is turning out to be 20. But there is also one other major conclusion over here. And that conclusion is with respect to the maximum gain. Understand this. Maximum gain. Your maximum gain will be higher strike price minus lower strike price. Okay. Minus net premium paid. This is what will happen in a bull spread. Your maximum gain is also capped. Your maximum gain is also capped. Capped means it cannot go above it. Okay. This is E. It cannot go above this. There is a ceiling limit. Beyond that, you will not be able to gain. In our example, the higher strike price is 350. The lower strike price is 300. Okay. And the net premium paid is 20. So this will turn out to be 50 minus 20, and that turns out to be 30 rupees. In a bull spread, you can never gain more than rupees 30. Whatever may happen, you will not be able to gain more than rupees 30. If you don't believe me, I take you back to the calculations. What do you say? In the first case, you are gaining. Second case also you are gaining. Even in the second last case also you are gaining. But look at the gain. 30 rupees, 30 rupees, 20 rupees. You are simply not able to gain more than rupees 30. That's the maximum of maximum gain that you will be able to make. So the moment I design a bull spread, I know from the very beginning that my loss will be restricted to 20 rupees and my gain will be restricted to 30 rupees. I will not lose anything more than 20. I will not gain anything more than rupees 30. Comfortable? Yeah, in case if you are still doubting the maximum gain, okay. Let's take an extreme situation. What if the share price rises and becomes 3,000? Right? I'm just illustrating you that how the gain can never cross rupees 30. Let's say the share price, which was 320 right now, it keeps on rising and becomes 3,000. You have a call option at 300. So you can buy at 300 and sell at 3,000. You just can't believe your luck. You're like, my God, what has really happened? You can buy at 300 and sell at 3,000. Tell me, how much money will you make? 2,700. But let me tell you, the person who has purchased the call option from you is, if not more, definitely equally excited. The person who has purchased the call option from you can buy at 350 and sell at 3,000. That person can buy at 350 and sell at 3,000. Tell me, how much money will that person make? That person will earn 2,650. That person's gain is our loss, right? It's going to be our loss. And because it's going to be our loss, we will have to pay 2,650. So it turns out to be 50 rupees over here. And then 20 is the net premium. And then your gain is 30 rupees. So you are back to earth, isn't it? It turns out to be rupees 30. As such, the figures are pretty clear, but still, yes, if you wish, you can write these figures as negative. See, these are options that we have sold. Okay, this is an option that we have sold. And when we sell an option, we have only obligation. So the person who has purchased the option from you, that is the person who will be deciding. The moment that person exercises the option, that person will gain, but that person's gain will be our loss. So if you wish, yes, you can write these figures as negative if you wish, if it was not clear. I was banking on that it is a short call, so we will have to pay, right? So long call, I will receive 100 rupees. Short call, I'll have to pay 50 rupees. And this is how it will be done. And yes, there's net premiums also. If you wish, you can write as negative. right? If you wish, you can write this as negative. And finally, we are getting our net payoffs.